Hello and welcome to interest.co.nz. I'm Gareth Vaughan and I'm joined by Dan Bell from HiFX with our monthly look at the currencies markets, the Never a Dull Moment report. And welcome in again, Dan.
Thank you.
I guess we better kick off with the US Federal Reserve, the FOMC meeting overnight. No surprises there?
Yeah, no surprises there. So the Fed announced monetary policy overnight. They've left interest rates on hold at 0 to 0.25% and maintained their current money printing policy, which is about $85 billion a month in Treasury purchases. So steady as she goes on the printing press in the United States. And as we know, that's been a major theme for global financial markets since the global financial crisis. And based on today's announcement and statement, it doesn't look like they're going to be putting away the printing press anytime soon.
Yeah, I think in our previous interview, or maybe the one before that, there was very much a more upbeat tone of economic data coming out of the US, but it's really weakened off again now. What do you think's behind that? And you had been talking about the possibility of the Fed sort of pulling back or even coming out of QE, but that doesn't seem to be an option right now, does it?
It doesn't seem to be an option right now, but earlier in the year the economic data had been better, and certainly the last quarter of 2012 was better, where we saw the employment numbers getting up over 200,000 new jobs. I do think the whole fiscal situation in the US is having an impact, so there's a fiscal drag going on. Government spending has been reined in over the last few months, and I think that's having an impact, and we know that the sequestration and the other fiscal issues earlier in the year and towards the end of last year, I think they're starting to really show up in some of the numbers that we're seeing at the moment. So the data out of the States hasn't been that flash. But inflation, is still very low, and given that outlook, it looks like the Fed are going to maintain their current policy stance. But there are still some of the voting members in the Fed concerned about what they're doing. Now, by early 2014, the Fed would have expanded its balance sheet by $4 trillion through this money printing, and that's a lot to deal with. At some stage, they're going to hope to try and exit this position, and that's going to be difficult. So I think there is still some doubt there. I think if we did see a real pickup in the US economy in the second half of this year, then I do believe that you will see the market start to price in a tapering off in this stimulus approach. Not to mean that the US are going to be raising interest rates anytime soon, but as the economic data improves, there will certainly be more concerns about this unconventional policy response that they're undertaking, and ultimately when they do start to talk about tapering off this QE, it should be positive for the US dollar and generally negative for the New Zealand dollar. And
the next key piece of data out of the US, I believe, will be the non-farm payrolls, which is always closely watched. And obviously with the Fed having that target of wanting to get unemployment down to 6.5%, it's really important at the moment. What are we expecting in those figures?
Yeah, so that's unemployment number out of the States is expected to remain up around 7.6%, and employment growth to be around 150,000 new jobs. Now, unless they're getting employment growth of more than 200,000 jobs, it's not really going to be doing a lot in terms of adding anything substantial to the economy or bringing that unemployment rate down. So, but if it comes in at around consensus, I think that'll be enough for the time being. We won't see a huge sort of risk aversion or anything. But certainly the last few weeks, the data out of the States has been weak, and we have started to see the market react to that a little bit more. Overnight, we had some weaker ISM manufacturing data and weaker employment numbers out of the US, the ADP employment numbers, which are a precursor, and that saw a 1% drop in stocks, and commodities were off quite sharply again overnight as well.
And we've seen some interesting moves in gold and commodities of late. What's really driving that? I mean, gold in particular, it's been down under $1,500 an ounce.
Yeah, well, gold is a very interesting one, and gold has been used by investors as a hedge against inflation and as a safe haven asset against this current ongoing risk and recession that we're going through. So, but I think the big drop that we've seen in gold lately has got more to do with the fact that the inflation that some investors were looking for just hasn't come about.
Yeah, from the QE, I guess.
Yeah, from the money printing. So everyone was thinking, well, if all these global central banks banks, and you look at the Bank of Japan, the Bank of England, the ECB in the US, all the biggest central banks in the world are out there printing money. Surely that's going to create inflation, but the fact is that it hasn't, and in fact there is some concern about disinflation in certain economies at the moment. So yeah, we just don't have inflation, and I think the big drop that we've seen in gold prices is essentially some investors recalibrating their outlook towards using gold as an inflation hedge, and so that's gold for you. In terms of the other commodities, I think you're seeing this kind of ongoing choppiness with industrial and other base metals. So, for example, copper prices are sitting at about an 18-month low at the moment. Oil prices are also trending lower, and I think that's got more to do with concerns about the global growth outlook and the fact that Europe's still in a recession, the US is basically muddling along, Asia and other emerging economies are weaker than they have been. So ultimately, if there's no real global growth to speak of, then you could argue why commodities should be so high.
And a little bit closer to home than the US, Australia, we've got the Reserve Bank of Australia next week with a cash rate review. Obviously, things in Australia are not looking quite so bright on the economic front at the moment. What are we expecting from the RBA?
Yeah, no, the Australian story is interesting. They had a manufacturing number out this week, which was the worst since 2009. Their terms of trade have peaked. We know that the investment into resources and mining has peaked and is starting to really sort of taper off. Export commodity prices in Australia's major markets are starting to drift low. As I mentioned, copper prices are at 18-month lows. Iron ore prices are weaker, and recent run of data out of China has been worse than expected. So the market's picking no rate cut from Australia next week, although one of the leading commentators out of Australia has mentioned this morning that he thinks it's about a 50-50 call on the basis that there is no real inflation to speak of in Australia, and that if you can cut interest rates at this time, then why wouldn't you? Especially considering Australia still has one of the highest cash rates in the developed world at 3% compared to ours at 2.5%, and obviously compared to most other economies it's still very high. So they've still got room to move, and if they want to try and rebalance their economy, then they would like to see the Australian dollar trend lower, which would give some relief to their manufacturing exporters in other parts of the economy. And
how's the Kiwi dollar been looking against the Aussie dollar?
Yeah, pretty strong actually. It's sitting over a 3.5-year high at the moment. So the Kiwi-Aussie rate is just trading under 83 cents, and that had a rally up over 82 cents a few weeks ago, and then it came off after some better news out of Australia and the drought, the concerns about the drought impact in New Zealand. But that started to really come up again, and it's trending higher. It does look like it's going higher from here. With the market expecting Australia to cut interest rates, and with the outlook for New Zealand less certain, if anything, we're probably expecting our central bank to raise interest rates certainly before they cut interest rates. Then the interest rate differentials are certainly starting to favour New Zealand more. Also, I think there's some more good news stories in New Zealand, depending on how you look at it. But the Christchurch rebuild and the stronger housing numbers that we're seeing across New Zealand are certainly a positive for the New Zealand dollar, as are the dairy prices, which have been quite volatile lately, and the Fonterra dairy trade prices were down around 7% overnight, but overall they're much stronger than last year. And you compare that with Australia's major export prices like copper and iron, and we are significantly outperforming Australia in that sense. So the New Zealand-Aussie cross rate goes higher from here, and ultimately that's not a great thing for New Zealand, because Australia is still our largest trading partner, although China's catching up, and last month China did take more exports, but Australia is still our largest export market, and that's going to take some of the cream out of the exporter earnings that we're getting in Australia. And
that New Zealand dollar is still stubbornly high against the US dollar, obviously with all the QE going on. It's not going to come down very far anytime soon.
Well, listen, it doesn't look that way. I mean, at the end of the day, the New Zealand dollar would be nowhere near where it is at the moment. It's sitting around 85 cents against the US dollar. It's actually down from recent highs just under 86 cents. It got down to about 84.60 or so overnight. So it's sitting around 84.5 to 85 today. At the end of the day, if the Fed weren't out there printing money in the US, we would be much lower. And my view on that is that whilst we're not going to see a change to Fed policy this year, we may well start to see a pickup in the second half of the year, and that should bring the New Zealand dollar down. And I think overall the global growth story, which is looking pretty sluggish at the moment, isn't really favouring growth commodity-based currencies like the New Zealand dollar. So I think that's going to play a bit of catch-up. But right here, right now, it's all about yield, and at 2.5%, our cash rate is pretty attractive. Investors are looking at our government bonds, and you can pick up, say, 4% thereabouts for 10 years. It's pretty hard to find that anywhere else, particularly with a government to debt. Debt to GDP ratio much lower than a lot of our other G10 peers, and a reasonably positive outlook for the economy over the next 12 months. So on that basis, the New Zealand dollar is certainly not going to drop out of bed anytime soon, but as we do get closer to the end of the year, and if we do see an improvement in the US economy, I would still argue that we should be much lower against the US dollar.
You talked previously of maybe around 75 cents even. Is that, do you think that's looking a long way off at the moment?
It does look like a long way off at the moment, but I'm going to stick to that view that we're going to be closer to 75 than 85, and ultimately, we're sitting at 85 cents at the moment, so we'd have to see a pretty big fall for that to eventuate. But I think it's certainly possible if we do see a continuation in commodity price weakness, and if we did see an improvement in the US economy by the second half of this year. So we'll wait and see. And
now moving on to Europe, we've got the European Central Bank's rate review tonight. Obviously, they've got a basket case of an economic area there at the moment, especially the south of the EU anyway. What are we expecting from the ECB, and will it make any difference?
Yeah, it looks like the ECB will be cutting interest rates by 25 basis points tonight. That's certainly the expectation of markets.
That would take them to half a
percent on the refi rate. Yeah, so that is pretty much priced in at the moment. Funnily enough, it's actually been viewed as positive for the euro. So the euro versus the US dollar is up about 1.5-2 cents on that expectation, and that's where the market's view of the euro situation is seeing an interest rate cut as positive for the region and for the currency. It's not so much focused on those interest rate differentials, whereas if we were talking about cutting interest rates, clearly it would be negative for our currency. But so that's due out tonight. I mean, at the end of the day, I don't know what difference really 25 basis points is going to do for Europe, as we know that they're in this ongoing, lingering recession. We have seen some better news out of the UK lately, but it's still pretty average. Out of a lot of the peripheral economies in Europe, it's still very, very hard going, and a lot of the news and data out of the core economies, Germany and France and Italy, is still pretty average. So I think the ECB will give them a little bit more. Will try and give them a bit more of a break, cut the interest rate there, and but I do think it's probably a buy the rumour, sell the facts scenario, and we'll see the euro run out of momentum overall.
Well, thanks for that, Dan. That's Dan Bell from HiFX, and I'm Gareth Vaughan at interest.co.nz with our Never a Dull Moment Currencies Report.